Hello everyone, and welcome to this training session about Brexit and Sage 200 Cloud. In this video, we cover the legislation changes relating to Brexit and how you can use Sage 200 Cloud to process under the new legislation. So before we look at what's changing, let's start with a quick overview of Brexit. I'm sure you're all very familiar with the word Brexit, but just to give you a bit of a recap, it's an abbreviation of the words British and exit, and the official definition from the Oxford English Dictionary is the withdrawal of the United Kingdom from the European Union. Just to cover a little bit of the timeline on this, because the process started approximately 4.5 years ago now, on the 23rd of June 2016, when the UK public voted to leave the EU. The following March, 29th of March 2017, the government triggered Article 50, which is an EU treaty that sets out how EU states can leave the EU with Parliament approval, thus starting the 2-year countdown to the 29th of March 2019, which was originally intended to be Brexit Day, when the UK would leave. But there have been various delays and postponements, and at the start of this year, 31st of January 2020, we finally officially left the EU and entered the transition period. That transition period has nearly ended and will officially end on the 1st of January 2021. So as we've just said, on the 1st of January the transition period will end, which means, amongst other things, the UK will leave the EU VAT regime. And this means that the UK will need to treat sales and purchases to and from the EU as rest of the world exports and imports, and can no longer treat them as intra-community supplies and acquisitions. Similarly, other EU countries, including the Republic of Ireland, will also need to treat sales and purchases to and from the UK as rest of the world exports and imports. This will mean these goods will now have to go through a complex export and import process. It will also impact how UK businesses apply VAT to these transactions and account for them on their VAT return. However, these changes are complicated by the Northern Ireland Protocol, which keeps Northern Ireland tied to the EU in respect of goods. So what do we mean by the Northern Ireland Protocol? Well, the aim of it is to avoid a physical border between Ireland and Northern Ireland. And the implications are expected to be the same regardless of whether the EU and UK reach a free trade agreement or not. Under the protocol, EU VAT rules will apply to Northern Ireland in relation to goods, but will not apply in relation to services. And this has resulted in much uncertainty around what trade between Great Britain and Northern Ireland will look like. Although it's worth saying that HMRC's view is that this is now largely defined. In fact, HMRC has recently published additional guidance around Northern Ireland and VAT. And the guidance confirmed that you're trading under the protocol if your business is VAT registered, and either your goods are located in Northern Ireland at the time of sale, you receive goods in Northern Ireland from VAT registered EU businesses for business purposes, or you sell or move goods from Northern Ireland to an EU member state. You'll be automatically identified as falling within the scope of the protocol if your VAT registered address has a BT postcode, and VAT registration certificate shows a type of business that's not solely involved in the provision of services. To check if you're trading under the Northern Ireland Protocol and what to do, there is excellent guidance on the gov.uk website via the link you can see on screen. Let's move on then and take a look at what's changing, starting with the UK, including Northern Ireland. First, let's look at importing goods, business to business, or B2B. So before the transition, if we start with importing goods from the EU, they're referred to as acquisitions and no custom processes are required. UK VAT would be applied via reverse charge, and VAT is calculated by the customer based on the invoice value. And the tax point's dictated by the normal tax point rules, which is usually the invoice date. In terms of importing goods from the rest of the world, they're referred to as imports, and UK import VAT would be applied at customs. VAT itself is calculated by customs based on the import value, and the tax point is the date that goods were cleared for free circulation at customs. Post-transition, all imports to Great Britain will be treated how rest of the world imports are treated today. Northern Ireland will continue to treat EU acquisitions and rest of the world imports as they do today. However, to ease this process, import VAT can be accounted for via postponed accounting. The UK government have confirmed that postponed accounting will be available for all imports, so that's EU and non-EU, from the 1st of January. Like the reverse charge mechanism used for EU trade, whereby import VAT is not physically paid up front and then reclaimed on the subsequent VAT return, but is instead accounted for as input and output VAT on the same return. The net effect's the same, but the importer benefits from not having the initial cash outflow, which is then recovered. It's optional on an import declaration basis, but it's mandatory if you defer the submission of customs declarations. A new online monthly statement will be available, which will show the import VAT postponed for the previous month on a transactional basis, and when you should include it in your VAT return, i.e. the correct tax point. Postponed accounting will be available for all UK businesses, including Northern Ireland. Northern Irish businesses will not need postponed accounting for goods coming from the rest of the EU because there's no import VAT, but they could still use it for rest of the world imports and potentially for imports from Great Britain. To summarise postponed accounting, let's take a look at how it works without postponed accounting versus how it works with. So without postponed accounting, UK VAT registered businesses importing goods to the UK will be required to pay import VAT on or soon after the time that the goods arrive at the UK border. But with postponed accounting, those UK VAT registered businesses importing goods to the UK will be able to account for import VAT on their VAT return, rather than paying the import VAT on or soon after the time that the goods arrive at the UK border, so they don't have that initial outlay of money. Something else that's new is the £135 import scheme for the import of goods. So at the end of the transition period, the UK government will introduce a new model for the VAT treatment of goods arriving into Great Britain from outside of the UK. For imports of goods from outside the UK, in consignments not exceeding £135 in value, the point at which VAT is collected moves from the point of import to the point of sale. This means that UK supply VAT rather than import VAT will be due on these consignments. For business to customer, the UK VAT will be charged by the foreign seller. For business to business, the UK VAT will be reverse charged to the UK customer. The scheme is mandatory and it's for Great Britain only, so it's not relevant for Northern Ireland. Something else to mention is that low value consignment relief, or LVCR, which relieves import VAT on consignments of goods valued at £15 or less, will be abolished. If you want to find out more about the new scheme, you can do so via the link you can see at the bottom of the screen. Now, we just mentioned that scheme isn't relevant for Northern Ireland. So if you want further guidance on how VAT will apply for goods imported into Northern Ireland from outside the UK or EU, you can find that using this link you can now see on screen. Moving on to services then, and before the transition, the general rule is that business-to-business sales of services are generally subject to VAT in the country of the customer, with some exceptions. Therefore, VAT is usually applied in the country of the customer via reverse charge. Business-to-customer sales of services are generally subject to VAT in the country of the seller, but with some exceptions. Digital services covered by the MOS scheme, for example. Therefore, generally the seller should apply UK VAT. Otherwise, apply VAT of the destination country, which you may be able to report through MOS. After the transition, these basic rules are the same globally and will not change as a result of Brexit. However, the UK, so both Great Britain and Northern Ireland businesses, will have to start using the non-union MOS. And UK businesses will no longer be able to apply the €10,000 MOS threshold, meaning more businesses may register for MOS and have to apply VAT of the destination country. Just to emphasise that these are general rules, but it does illustrate that, with the exception of registering for the non-union MOS scheme for services, you'll likely carry on doing what you are today. If you're in any way unsure, please speak to your accountant. Next, we have exporting goods. So pre-transition, starting with exporting goods to the EU. For business to business, intra-community business to business sales are known as supplies. Providing the supplier has verified the customer's VAT number, the invoice is zero rated, and VAT is applied to the destination country through the reverse charge. For business to customer, intra-community business to customer sales are known as distance sales. Below the distance selling threshold, VAT of the seller's country is applied. And above the threshold, the seller has to apply VAT of the destination country. For exporting goods to the rest of the world, all rest of the world exports are zero rated for UK VAT, regardless of whether they're business to business or business to customer, and tax may be applied in the destination country via import procedures. Post-transition, all exports from Great Britain will be treated how rest of the world exports are treated today. This may result in additional EU VAT registrations, and Northern Ireland will continue to treat EU supplies and rest of the world exports as they do today. Something else that's changing is the VAT return. Now, it was originally anticipated that there would be no changes to the wording of the VAT return boxes as a result of postponed accounting or leaving the EU VAT regime. But in November 2020, this decision was reconsidered, and boxes 2, 8 and 9 will be changed. These changes don't take effect until the 8th of April 2021, and the function of the boxes will remain the same. But just for your awareness, the new wording of those 3 boxes is as follows. So box 2 will say VAT due in this period on intra-community acquisitions of goods made in Northern Ireland from EU member states. Box 8 will say total value of intra-community dispatches of goods and related costs excluding VAT from Northern Ireland to EU member states. And finally, box 9 will read total value of intra-community acquisitions of goods and related costs excluding VAT made in Northern Ireland from EU member states. Other things to consider are EC sales list, Intrastat and MOSS. Starting with EC sales list, and any goods sold under the Northern Ireland Protocol should continue to be reported on an EC sales list. Other than this, EC sales list will no longer be required. For Intrastat, businesses moving goods under the Northern Ireland Protocol will still be required to prepare Intrastat arrival and departure declarations for these goods. Goods not covered by the Northern Ireland Protocol will still need to be reported on Intrastat arrivals declarations, but that's only on a short-term basis for 2021 in order to gain the required statistics. Finally, Mini One-Stop Shop, or MOSS. Any business using the VAT MOSS scheme will need to transfer from the Union scheme, which is for businesses in the EU or have a branch in the EU, to the non-Union MOSS scheme for businesses not established in the EU. You can find more information on MOSS and the link you can see on screen. Then we have Northern Ireland VAT registration. Under the Northern Ireland Protocol, EU VAT rules will continue to apply in Northern Ireland after the end of the transition period in respect of goods. In terms of change, if you're trading and make transactions under the protocol, you'll need to use an XI prefix in front of your VAT number when communicating with an EU customer or supplier. So your invoices will show an XI number ahead of your VAT number. For example, XI 123456789 instead of GB. It's worth pointing out though that as far as we're aware, there's no requirement to apply for or be issued with an XI VAT registration, i.e. it's sufficient just to use the XI in front of your existing number. EORI numbers next then. So if you import or export goods into or out of the EU, you need an EORI number. Previously this would only have been a UK requirement for imports and exports outside of the EU. But from January 2021, there'll be a requirement if you move goods between Great Britain, so that's England, Scotland and Wales, and the EU. You may also need one if you move goods to or from Northern Ireland. And if you move goods between Northern Ireland and non-EU countries, you'll need an EORI number that starts with XI. If you need to get an EORI number, then you can do so from gov.uk/EORI. Let's move on to commodity codes, which are standardised numbers allocated to goods in order to classify them for the purpose of calculating the correct tariffs and taxes upon importation into a country. They're required for import and export declarations, but aren't required for EU intra-community trade, although they are used for Intrastat reporting. Previously, UK businesses therefore only had to use commodity codes when trading outside of the EU, or for completing Intrastat reporting, but will now be required to use them when trading with the EU. Commodity codes aren't a requirement for a VAT invoice, but they should be included on any commercial invoice. If you need to look up commodity codes, duty and VAT rates, go to gov.uk/trade-tariff. That's the UK covered then, but what's changing in the Republic of Ireland? Let's take a look. Well, first of all, sales of goods to Great Britain will now be treated as rest of the world exports. Any sales of goods to Great Britain with a consignment value under £135 will now be covered by the new UK import scheme. For business to business, UK supply VAT is accounted for by the customer via a reverse charge. For business to customer, UK supply VAT is charged by the seller who will need to register for UK VAT. Purchases of goods from Great Britain will now be treated as rest of the world imports. Sales and purchases of goods to and from Northern Ireland will continue to be treated as intra-community dispatches and acquisitions. But you will need to use a new XI country code to reflect these transactions on supplementary reporting and use the XI VAT registration for Northern Ireland customers and suppliers. Great Britain should be excluded from Intrastat reporting and EC sales list reporting, and Northern Ireland should be excluded from a services perspective. UK, so that's Great Britain and Northern Ireland, should be excluded from MOS reporting. Any UK VAT due on business to customer sales of services will now require the seller to register for UK VAT. And finally, you will need to use EORI numbers and commodity codes when trading with Great Britain. We talked about postponed accounting in relation to the UK a little bit earlier, but in terms of the Republic of Ireland, under previous no-deal Brexit preparations, the Republic of Ireland confirmed that they would also implement postponed accounting. And this was to reduce friction and cash flow impact on Irish businesses of import VAT as a result of trade from Great Britain to the Republic of Ireland. Now, the underlying legislation required for postponed accounting in Ireland has now been laid before Parliament and will make its way through the various stages. Revenue have issued some high-level guidance, which hopefully provides some reassurance that it is coming and will be in place for the 1st of January, along with the required changes to the VAT3 and RTD forms. And you can find this information on the link you can see on screen. Finally, from a legislation changes perspective, it's worth considering a Brexit impact assessment. Some tangible things to think about and do to be ready for January. Let's take a look at an example. So here are 5 questions for you to answer to ensure you've got everything in place for the end of the transition period. Starting with import, export and logistics. So does your business import or export goods to or from the EU? On the back of that, we've got EORI. Do you need to register for an EORI number? And remember, you've got the link that we talked about earlier. Northern Ireland Protocol. So does your business trade under the protocol? In terms of taxes and money, is your business VAT registered, or do you operate under the VAT MOS scheme? And finally, software, which we'll talk about in a minute. Is your account software up to date? So as promised, let's talk product and see what new features there are in Sage 200 Cloud to help you process under the new legislation. To take you through that, I'll pass you on to James.
Thanks, Ian. So in this next section, we will be covering the in-product changes for Sage 200 Cloud. These changes are the same for all variants of Sage 200 Cloud. So whether you are using Professional or Extra or Standard or any of the variants, this next section will apply to you. From the 1st of January, the way you trade with businesses and customers outside of the United Kingdom will be changing. This will mean a slight change in how you process certain transactions and features within your Sage 200 Cloud software. There will be 2 new VAT rates which you can add to the software. One for purchasing goods from the rest of the world and using postponed accounting, and another for purchasing services from the rest of the world where a reverse charge is required. For exporting goods, existing VAT rates can be used, as you will now treat exports to the EU just as you would an export to anywhere else in the world. The new rates will be 16 for services and 18 for goods by default. The new VAT rates can be created from within your VAT rate settings whilst you are on the latest version of the software. There will be a button to create import-export VAT rates at the bottom left of the window. Clicking the button will prompt the software to create the 2 new VAT rates, 16 and 18. If you already use these rates for something else, you can manually create the new rates. Just be sure to allocate the correct terms and VAT percentages against the new VAT rates. As a reminder, VAT rate 16 will be used for purchasing a service from the rest of the world where a reverse charge is required. The terms for this rate are not new and already in use for VAT rate 6 in our case, which is used to purchase services from the EU. The difference between my VAT rate 6 and VAT rate 16 is that 16 has a VAT percentage assigned. VAT rate 18 will be used for purchasing goods from the rest of the world, where we are taking advantage of the postponed accounting. The terms used for this rate are brand new, and it once again attracts a VAT percentage. The Brexit legislation is still being discussed at the time of this recording, with talks of a potential deal coming in, which means it is a constantly evolving situation. HMRC have just clarified that they would like businesses to differentiate between goods above and goods below the UK Low Value Import Scheme threshold. To do this, you will need to create an additional VAT rate by selecting the Add button at the bottom left of your VAT rate settings window. The new rate will be for items below the UK Low Value Import Scheme threshold and will have the same settings as our VAT rate 18. The difference being the name to help us easily separate which goods were above and which goods were below the threshold. We would recommend using VAT rate 19 and filling in the details just as you see them on screen now. Make sure to click the OK button at the bottom left to save your changes. The VAT return window will remain the same. There are no changes or additions to the VAT labels at this moment. However, in April 2021, the labels will be updated to reflect more accurately what it is they represent. This change will happen automatically and does not change how you process the VAT return. As Ian mentioned earlier, the boxes being impacted will be box 2, 8 and 9. As Britain will have officially left the EU, you should check your country code settings to make sure that the GB country code does not have the EU tick box set. We can remove the tick by clicking on the EU box, and then to save the changes, click the OK button. We're now going to take a look at some specific examples around where you may need to use the new rates, but also look at how current VAT rates, which are already available in the software, can be used too, starting with imports. When purchasing a service from a business based outside of the UK to be supplied within the UK, the transaction could be subject to UK VAT. In this situation, we would use the new VAT rate 16. Using VAT rate 16 applies notional VAT, meaning that the VAT value will populate in both box 1 and box 4 on the VAT return, which will mean no overall impact on the value owed to HMRC. VAT rate 16 will also place the net value in both boxes 6 and 7 on the VAT return. Let me show you this rate in action with an example. Here I have a French supplier who is supplying me, a UK business, with a service, and this service does attract a reverse charge. Before I enter an invoice, let's take a look at the supplier's record. On the Trading tab, you can set a default VAT rate. Here I have changed the default VAT rate to the new VAT rate 16, as this supplier will now be classed as a rest of world supplier and the service I commonly purchase from them attracts a reverse charge. By doing this, it should save me time when processing future transactions, as I won't need to change the VAT rate each time from within the invoice window. You still input the invoice in the same way. For this example, I'll create a rapid invoice to save some time. You can see that entering an invoice remains the same. From this window, I can amend the dates, exchange rates, references, and nominal codes. If we move over to the right-hand side, you can see the new VAT rate 16 has been pre-populated due to the default rate assigned to their record. Remember, this VAT rate does have a percentage assigned, which will also populate here once I enter a net figure, but it's nothing to worry about as it's notional VAT. With all the detail entered, I can save the invoice. Now the invoice has been posted with the new VAT rate, let's take a look at our VAT return. Rate 16 is applying notional VAT, so we should be able to see the VAT from the invoice I have just posted in boxes 1 and 4. You can drill in for more detail regarding transactions that have impacted particular boxes on the VAT return by selecting the highlighted value in that box. If we look at box 1 and move down to the new rate 16, you can see the invoice I have just posted. We can then do the same for box 4 to make sure it's posted here too, and therefore will not be increasing how much VAT I owe HMRC for this VAT return. You would not need to check these boxes for every transaction using the new rates, but you may be curious and want to look just to satiate any worries you might have about the new rates working correctly. So as you can see, processing is staying very much the same, as is the VAT return. We just need to keep an eye on the VAT rate we are choosing to use to make sure the VAT return is being impacted in the correct way. Not all services purchased from businesses outside of the UK will attract a reverse charge. This will mean that certain services purchased outside of the UK will just need their net element to be hitting the VAT return. When this is the case, you can use the zero-rated VAT rate, which should already exist in your software. If you are ever unsure as to which tax treatments the services you purchase from outside of the UK attract, we would recommend checking in with your accountant, or you can visit the HMRC website. If you are importing goods from outside of the UK and looking to take advantage of the postponed accounting, you can use VAT rate 18. This is an optional decision which can help with cash flow, but will be mandatory if you are deferring the submission of customs declarations. And remember, this can be used for all imports of goods from any country outside of the UK, not just the EU member states. The rate itself works in a similar way to VAT rate 16, which we've just looked at, by applying notional VAT which impacts boxes 1 and 4 on the VAT return. However, the net element will only then impact box 7. The VAT rate itself does have a unique set of terms which differ from the already available reverse charge rates in the software. There should be a separate rate used for goods below the UK low value import scheme threshold, which in our case would be VAT rate 19 as demonstrated earlier. In this example, I'm going to be buying goods from an Italian supplier. Once again, I already amended the supplier's record so that their default VAT rate is now set at 18. Now let's process an invoice for this supplier. When entering the invoice, as I've already mentioned earlier, the process stays the same. The key thing to keep an eye on here will be the VAT rate. In our case, when I enter the net value, the VAT value is also calculated as the default VAT rate has been pulled through. If I needed to, I could easily change the rate from the drop-down menu. Now all the details are complete, we can save the invoice. With the invoice saved, it should have impacted my VAT return. If we open the VAT return and take a look, I'm expecting this rate to have applied notional VAT. Like our earlier example, this means the VAT should be in both box 1 and box 4. Let's take a look at the boxes. If we scroll down to our new VAT rate of 18, you can see the invoice I've just posted. If we also took a look in box 4, and once again, just scroll down to the new VAT rate of 18, the VAT for the invoice is here as well. So this is going to result in no additional VAT being owed to HMRC for this purchase. Lastly, the net element should be impacting box 7. So we can take a look at that too. This is the rate that you use when you do want to take advantage of postponed accounting. But what if you do not want to take advantage of that? You've just seen how we can process goods being purchased from the rest of the world whilst taking advantage of postponed accounting. But as postponed accounting is optional on an import declaration basis, if you are not looking to take advantage of postponed accounting, you can account for the VAT straight away. You will need the VAT element to hit box 4 and the net element to hit box 7 on the VAT return. There should already be a VAT rate set up in the software to handle this, the standard rated VAT rate. The choice here is yours, but if you are not already familiar with the tax treatments on all of the goods and services you currently import to the UK, please get in touch with your accountant. There is advice on the HMRC website also, although I often find it easier to digest information when I'm talking to a person rather than trying to navigate and read a web page. Now that we've looked at importing items from the rest of the world, we can take a look at exporting items to the rest of the world. Unlike import transactions, export transactions will not require separate or new VAT rates. All exports from Great Britain to the EU are to be treated how rest of world exports are treated today. These will be able to be processed using current VAT codes already in use in the program. EC sales list will no longer be required for Great Britain. For Northern Ireland, the EC sales list will be required for goods, but not for services. When exporting our goods, we just need to establish whether or not they will or will not be subject to VAT. For any exports which are subject to VAT, you can use the standard rated VAT rate. Where you have exports which are not subject to VAT, this would usually lend to them being zero rated, which is also a VAT rate already available in the software. Again, if you are unsure as to where VAT does or does not apply to your exports and in what context, please check in with your accountant or the HMRC website. Ian talked earlier about the EORI number. This is not something brand new for this coming January, and is a feature which has existed in the software for a little while now. If you need to enter your EORI number into the system, you can do this from within the company details. Just in case you've forgotten whether or not you need one of these, I'll go back over the key points. If you import or export goods into or out of the EU, you need an EORI number. Previously, this would have only been a UK requirement for imports and exports outside of the EU, but from January 2021, there will be a requirement for any UK import or export. If you move goods between Northern Ireland and non-EU countries, or make declarations in Northern Ireland, you will also need an EORI number that starts with XI. With all of that being said, here are a few things to consider checking over and amending ready for trading from the 1st of January. We should check our default VAT codes against the supplier and customer records, but in particular, it's your supplier records you should be looking at. For those suppliers who you are trading with from outside of the UK, as it may be worth setting their default VAT code to the new VAT codes 16, 18, or even 19. You should check your recurring items. Again, they could have the incorrect VAT code assigned to them at the moment. and we need to make sure that they're altered to account for the post-Brexit rules. Lastly, we'd need to double check on any incomplete invoices or orders, as the tax point of these will need to be considered. If the tax point falls after the 1st of January, then these invoices will need to be processed under the new post-Brexit rules. That concludes the Sage 200 Cloud Brexit training. As mentioned earlier, Brexit details are still being finalised, so there may be new pieces of legislation this video has not covered. We have just released our Sage Brexit Hub. The link for the webpage should be on the screen now. The Brexit Hub will be your first stop when looking for any changes or new developments in the Brexit world. Thanks for your time today, and we'll speak again very soon.